So I'm delighted to welcome Hermina to discuss the Schroeder BSc Social Impact Trust. When I met her recently, she shared a striking fact that poverty and inequality in the UK rank amongst the highest in the developed world. This conversation aims to explore how the Trust is addressing these issues and some of the challenges around investment trusts and impact investments. So I just want to kind of start with, perhaps could you give an overview of your background and career journey to date?
Thank you, George. And thank you for inviting me to this conversation. This is a subject very close to my heart, as you can imagine. So really appreciate the opportunity to share this with your listeners. So in terms of my background, I started my career in the City of London in 2004. I started in investment banking and I worked in the sector until 2015, mostly at Credit Suisse, which has now been acquired. And after that, I had a few years of career pivoting where I traveled and worked as a consultant and then started working in social impact investing in 2018. I started as a portfolio manager for social and sustainable capital and then moved on to Better Society Capital in 2021. At the time, it was still Big Society Capital to focus on the social impact trust. But a little bit more on background. This transition wasn't abrupt. It actually followed a pretty natural progression. I was always interested in global corporate citizenship, as Credit Suisse was calling it at the time, and I was involved in initiatives that involved working with charities, doing microfinance, and the broader sustainability sector as it was developing around that time. And increasingly, I started to feel that was more aligned with my fundamental principles of working in finance. And that's what led to my transition. And another important piece of context is that I'm originally Romanian. I grew up and came of age at the time after the fall of communism, which at the time was deemed the end of history and the victory of capitalism with its promises of freedom and prosperity. And I think working in the UK and in the city exposed me to some of these contradictions that you've just mentioned, with the UK being, one of the largest economies in the world, and yet there being a lot of inequality and 20% of the population living in poverty. So that's really what led me towards applying my experience in finance towards addressing some of these issues that I saw around.
And I want to go on and kind of explore a little bit about the trust itself and sustainability. But before we do that, I know the structure of this is an investment trust. And for some people, it may be something that they're not so aware of what they are. And although they've got this long history, I was trying to have a look to see how far they go back. And I think, but I may be wrong, that they go back to 1868 with foreign and colonial. So they have that history, and yet investors tend to shy away from them. And so I've got some questions around that. My first question is that they can appear to be complex, and I guess that's probably why investors avoid them. But what do you see as the key advantages of kind of the investment trust structure that makes them worth considering?
So I think some of the key attractions are the fact that they give access to a diversified pool of assets that are otherwise quite difficult to access because they're illiquid or because there are other barriers to access. And at the same time, because of the base of permanent capital, they allow the investment trust to pursue a long-term investment strategy. So particularly in our case, we've built a portfolio of private assets that are otherwise not really accessible to our retail investors. And it's a diversified portfolio, which now an investor can access buying one share. And I think in addition to that, the governance structure also provides additional protection for shareholders because we have an independent board that protects the interests of investors.
I think that's quite an interesting one because there have been recently this situation where kind of short sellers have come in and they've attacked investment trusts. So Civitas Home REIT are two examples of that. Civitas seems to have kind of recovered from that, but Home REIT obviously hasn't, and there are probably more structural issues, and so it needs to be wound down. So obviously you talk about this independent board governance, but I guess somebody who is aware of something like Home REIT, they may be nervous about a structure like yours. So can you talk about how you protect against the same sort of things happening?
Yeah, sure. I think investment trusts are not unique in being potentially targeted by short sellers or activists. That can happen to pretty much any listed structure. And usually these attacks are more not so much related to the structure, but to a value opportunity that stems from perceptions around governance or the quality of the underlying assets. And as we've seen more recently with the Saba situation, in fact, the governance resulted in shareholder votes that went against the activist. But I think for us and how we protect our own portfolio is by focusing on the quality of the assets and the oversight, and also communicating this to the market, because on the one hand there is any concerns that people might have around either the quality of the underlying portfolio or the quality of governance can stem either from actual problems or from a lack of transparency on how this quality is managed. So we're very focused on the quality of our portfolio, on doing very deep due diligence on the counterparties that we work with, and also communicating that as transparently as we can in our reporting, either annual reports or impact reports. So I think that hopefully mitigates any questions or concerns that people might have. And equally, if there are particular concerns that are stemming from market situations, such as Home REIT that you've mentioned, we're very happy to take questions and address specific concerns that people might have about our portfolio and how it might compare to other situations that they're seeing in the market.
I mean, I guess that's the thing, is that it's about being transparent, isn't it? It's being as transparent as possible, and maybe some of the issues of, and Home REIT, as you quite rightly say, it's it can happen to any company, can't it? And effectively, it is a company. So yeah, no, that's great. But in terms of investment trusts, and this is kind of the final question on investment trusts before I kind of talk about your trust in particular, is that there's kind of this perception that they've underperformed the kind of broader market. They kind of sit on this term which people call discounts. Is this a structural issue, or does this offer opportunities?
Yeah, I think we certainly see this as a sector-wide and structural issue. I don't think that's a challenging point. There's wide market agreement that the investment trust sector is quite challenged in its sort of history. The discounts are at their widest levels in several decades. And it's not the first time that market disruption caused a widening of the discount in the sector. So we've had the financial crisis or COVID that caused similar widening of the discount. What's different this time is how persistent the discount has been for such a long period of time, which I think people expected maybe a quicker reversal. We do see opportunities in this. So from a simple technical perspective, we see a buying opportunity that would enhance potential returns as prices come closer to NAV and discounts narrow. And we have reason to believe that the NAV of our particular investment trust is quite credible and justifiable to the market. So, for example, in the high impact housing asset class, we've seen nearly £500 million raised at NAV in the past 12 to 18 months, whilst our investment trust offers exposures to the same assets at a significant discount. So there is a double opportunity for investors of coming into the trust at this level. One is that there is this potential enhanced returns from the narrowing of the discount. And the second one is more immediate in that the trust also offers a dividend yield. So if our yield is about it's towards 3% of NAV, and at the current price levels, the enhanced yield is closer to 4%. So certainly there's an opportunity here. And I will say that there is more uncertainty around the timing of this narrowing of the discounts, which we acknowledge.
I guess that's for investors, is that if they're looking long term, you could almost argue that at this stage you're coming in, where other parts of the market are elevated, assuming that the investment trust market does correct, which we hope it will, then there appears to be some opportunities within that market space.
Absolutely. And I think, sorry.
No, carry on.
I think whilst a lot of this does have to do with market sentiment and broader macroeconomics, we have seen capital outflows from private assets as interest rates increased more recently. And as we see interest rates go in the other direction, we're also expecting the flows to reverse and to see more inflows back into private assets and then into investment trusts as well.
And there was this whole thing about pricing as well, wasn't there? That probably didn't help the market as well. Can you just touch on that very briefly as to what that is all about? Is this idea that investment trusts had to put down how much their costs were and everything, and that seems to have a negative impact, didn't it, on the market?
So I think a lot of the discussion around cost disclosures is very much more for the AFIMs or for the Schroders representatives. From our perspective as a portfolio manager, we're very sensitive of the costs that investors have in order to access this opportunity. We are only charging the management fee on the portion of the portfolio that's invested in high impact assets. And that's an 80 basis points management fee on that portion of the portfolio. So anything that sits in cash or in liquidity assets, so anything that's waiting to be drawn into these high impact portfolios, we're not charging a fee on it. We are trying to be as transparent as we can on the real costs of accessing this, and also think that in the context of where these private market opportunities do have management fees, which are market standard for those opportunities, they're not really accessible for the same investors that might want to invest in investment trusts. So we are hoping that we're transparent and that the fees that we're charging are fair and commensurate with the benefits that investors are getting from this investment.
Yeah, and I think that I don't have an issue on that, and I think you're absolutely right. It comes down to, when we talk about investment trusts, it's all about transparency. It's being very, very clear, so people can see. And I think also your honesty of when we talk about home REIT as well, if people got questions they want to ask, that's what you're there for. And I think that's really, really important. When we talk about the trust itself, so and again, correct me if I'm wrong on this, but I believe that the trust was launched in 2020 in partnership with Schroders, and its aim is to deliver measurable social impact alongside financial returns. You've touched on it a little bit in your history, but can you explain why this trust was set up and what you want to achieve through this?
Sure. So Better Society Capital, BSC, was founded in 2012 as a social impact investing wholesaler, i.e. it had a mandate to establish and grow the social impact investing market in the UK. We do that by investing our own capital, but crucially, in order to be able to grow, we need to attract other investors into the sector. So for several years after its establishment, BSE identified investable models that tackle issues of inequality and poverty in the UK, invested in these models and demonstrated their feasibility, and alongside attracted other institutional investors that helped us to grow the market to the size it is now, so nearly 12-fold over 12 years. But most of these investors are large institutions, family offices, pension funds, high net worth individuals. And BSE was interested in expanding this access to a broader range of investors that needed to be able to access the market more easily. At the same time, we were getting some inbound interests from some of our partners, where even certain institutions tried to build their own portfolios of impact investments, and they realized that actually building a diversified portfolio is time consuming and costly and actually requires a lot of resources. So we started working with Schroders and Cazenove to design a product that's more efficient, that leveraged BSE's expertise in diligencing these impact opportunities and packaged them in a product that's more accessible for client portfolios. So we were aware that in addition to deep impact, this product also had to offer stable, sustainable returns, and we were aiming for a low correlation to mainstream markets. And that's how we built the portfolio allocation policy to select some of the more mature and proven models that BSE had been investing in for several years and that were suitable to provide this dual objective of impact and returns.
So I kind of go back to the story behind investment trusts and services that I think that gives a lot of people confidence in who you are as a company. The fact that you've been around since 2012, it's not just something that's been around for 5 years. It's actually, the background is there. But what would you say kind of makes you different? And can you provide examples of where you have made that difference and how you evidence it?
Yeah, sure. So the key differentiator is the depth of social impact that is delivered through our funds and our investments. I think in the sustainability space, we see more opportunities, say, relatively in investments tackling climate change or environmental. And there is a recognition that targeting social impact is more difficult, both to implement as well as to evidence. I want to stress that actually this impact is delivered through frontline organizations. So we don't want to take credit away from them. So that's the charities and social enterprises who are working with the most vulnerable and disadvantaged people in the UK, tackling issues such as homelessness, unequal access to healthcare and the strain on healthcare resources, unequal access to education or fuel poverty. And what our role is to direct capital towards these enterprises who might not actually have access to mainstream funding. So to give an example of this, I'll focus on the high impact housing asset class and our fund, Social and Sustainable Capital, Social and Sustainable Housing Fund, managed by Social and Sustainable Capital. And what they do is they offer loans to charities and social enterprises that allows them to buy properties to deliver their services. So, for example, one of their organizations that they funded is Thrive Women's Aid. This refuge charity in Wales. They've been in existence for 45 years, helping women escape domestic violence through refuge accommodation and moving on with their lives. One of their key barriers was that it was difficult for them to move women on after refuge because of shortage of housing and uncertainty around being able to secure suitable housing. And that became amplified during the pandemic. So on the one hand, demand for their services increased. On the other hand, they were finding accessing move-on accommodation more difficult. So the Social and Sustainable Housing Fund provided a loan that allowed them to buy 20 properties that they could select, as in they could select the quality of these properties. They could refurbish them into safe, affordable homes for the women that they were working with and help move women on from refuge, start to rebuild their life, and also help them reach more people by freeing up refuge spaces. The alternative for this charity was either use the private rental sector and try to rent properties. The challenges that we're hearing is that there's just a shortage of homes to begin with. Rents increased a lot, and also they didn't really have a lot of agency in selecting the quality of the housing. On the other hand, they didn't really have access to just commercial mortgages to allow them to buy this. So this is where our contribution comes in. We provide this type of funding that allows these organizations to increase their impact, both in terms of the number of people that they're reaching and the quality of the services offered. And longer term, they also build their own resilience by building up assets on their balance sheet. So that's just one example. And there's a lot more in our impact report. We've published 3 impact reports so far. The latest, published in June 2024, is on our website. And that shows that since our IPO, we've directed capital in this manner to 194 organizations, so charities and social enterprises. And in turn, they have reached over 400,000 people, of whom 95% are vulnerable, disadvantaged, and essentially, thanks to this investment, they accessed essential services that really had a major impact on the quality of their lives.
As part of your research that you're doing, it must go into the charities or the organisations that you're lending, because I guess that may have been a bit of a criticism of Home REIT, was the quality of the organisations that they were working with. How do you think about those? Because obviously you talked about that one in Wales and how it's got a 45-year, it's been going for 45 years. So you would think actually it's probably a very strong organisation. So how do you think about that? Because that's got to be a risk associated with this.
Absolutely. And actually, you have identified one of the key criteria that we're looking at, which is the quality of the counterparties that we're working with. The average age of the organizations in our portfolio is nearly 30 years. So these are organizations that know their area of focus very well, know their beneficiaries, and have strong relationships with the local commissioners, because that's highly important for their success, because that determines the number of people that are referred to their services and also their ability to get payment for their services. A lot of these are paid for through local housing allowance or other payment streams that are backed by government revenue streams. So essentially, track record of delivery of these organizations is a key component. We also look at the statistics such as the number of people that are delivering the services. We're very aware that in order to deliver the kind of services that they have signed up to deliver, they need a certain level of staffing. So that was one of the other differences that we had identified compared to some other providers. And in general, we also look at their financial track record, their asset base, how they've been managing their relationships with other counterparties in the past, whether local authorities, whether use of grants, so just the usual financial due diligence. But we certainly follow the due diligence all the way through to the frontline organization delivering the services and the beneficiaries that benefit from the services offered.
Yeah, and I think that's the important thing. And I think that, again, I kind of keep going back to what you sort of said earlier about transparency, about the governance, independence, and I think that gives a lot of comfort to people. Is actually, it's not just about saying, oh, I've just set up a charity that's going to work in this area. It's about having that track record and how they operate. Do you ever get involved in the charities, or do you tend to just be kind of trying to think of the right word? Really, is it just a transaction, or is it much more that you want to get involved with them?
So personally, I was very closely involved. So having been on the side of managing the portfolio of one of our fund managers, I can speak from my own experience that I was very closely involved with the charities whilst they were getting the loans from the fund, as well as diligencing the properties. Personally, I was looking at every single survey report for the properties that were being bought, as well as arranging the reporting, the impact reporting that flows back. So we've got a very good visibility of what are the processes that should be followed, and we're reflecting that in the fund as well. And we're also trying to offer this opportunity to our own investors to have this visibility that goes all the way to the frontline organizations. So we're building this case study base. Our board has met several of the frontline organizations, and we're looking at as many opportunities as we can to bring these front lines in front of our own investors and share these stories, both for transparency and also to increase the visibility of the sector in general.
There's kind of this whole area of ESG, sustainability, all different types of names. And obviously the FCA, or the Financial Conduct Authority, have introduced these sustainable labels. And I believe that you've adopted the impact label. So it'd be interesting to understand a little bit about how you feel this aligns with your mission, and what does it mean for investors in practical terms? Because I know that some companies are really struggling with this. So yeah, it'd be interesting to get your thoughts around that.
Of course, we started from the outset with an impact objective. So we didn't feel that we needed to change anything that we were doing in order to pursue a label. And actually, we welcomed the labeling regime in order to be able to offer a standard to the market and also some validation of our own practices. So as in adopting the label, we didn't feel that anything that we were doing fundamentally changed in any ways. We amended our investment policy and objective to actually provide more detail and more transparency of all the processes that were happening anyways behind the scenes. And we've created some public documents, the pre-contractual disclosures and the client-facing disclosures, which are on our website, which describe our processes in more detail. So, for example, for each asset class and for each impact theme that we invest in, there's a very clear description of what is the impact that is targeted, how we do diligence opportunities, how we select the investments that we make, how we monitor them over the life of the investments, and how we deal with any risks and any potential adverse impacts. So we didn't think that the labeling changed anything from what we were doing, but it offered us a welcome opportunity to offer more detail, some more transparency. Hopefully that gives more comfort to investors that what we're saying at high level is happening in a great amount of detail. And I think it also offers this validation, external sign-off that gives additional comfort to investors in terms of selecting which funds are applying the impact practice they're claiming in their documentation.
And I think, yeah, because I think it's really interesting is because, one of my follow-on questions, which you've answered anyway, is that reporting. And I think it's quite interesting to see that there's kind of that additional oversight, or certainly the information you provide. So anyone who's looking at yours is, that they're very sure on what they're getting. Is there additional oversight from the regulator that on top of what you were already doing, or is it just kind of more, there's not a huge amount of change because you're already doing it? Do you feel that there's a bit more oversight, and is that good, bad, indifferent?
I think there certainly was quite a lot of engagement with the regulator whilst working towards the label. And we continue to have the same oversight bodies, so the independent board, as well as an investment committee that approves our investments and also is involved in monitoring them. That investment committee has members both from BSC as well as Schroders, and their oversight responsibilities have been extended to specifically monitor ongoing compliance with the SDR labeling regime. I think, as I said, while we actually welcome the additional transparency and oversight, I think it does help us validate the differentiation that the trust offers. And whilst there is some additional reporting, it's still fundamentally reflecting what we're doing anyway.
Yeah, and I think, ultimately we go back to our investors. If investors want to invest in something that is a true impact strategy, then they want confidence in what they're investing in. And certainly from what you're saying is that you're almost embracing what the Financial Conduct Authority have given you. You've increased the level of information that people can have. And in a way, that should give people confidence that something like, you can't say that something like a home REIT won't happen again, but it should give investors more confidence that should sort of stop that sort of thing happening if they want a true impact strategy. And kind of we're sort of coming to the end of this. And I kind of feel there's other questions I'd love to ask. I was thinking back to what we said at the start about poverty and inequality and how the UK ranks so high. And I sometimes think, how does that change? And that's probably an unfair question to ask you. But I guess maybe in a small way, that's what you're trying to do is, you can't change the world, but somebody's got to change. Someone's got to do something, haven't they, I guess?
Yes, and absolutely, we can't. We work as part of a bigger ecosystem. So certainly investment and what we do alongside with other aligned investors have their role. There's a crucial role of policy. And I think what we're seeing is that the current government, especially with their focus on missions, is signaling that is highly aligned with trying to reduce poverty and inequality. And I think we clearly see our role as part of a much broader market and ecosystem that needs to be coordinated in order to move the needle towards that change.
Yeah. I think that will always stick in my mind. And I think, I guess you growing up in a different environment to the environment that you come to the UK and you'd think that it would be a perfect country. And well, certainly some people in the UK might think it's a perfect country, but I guess there's poverty everywhere, isn't it? So so that's really interesting is kind of your thoughts on that. It would be interesting for you just kind of talk about, you've talked right at the start about your journey into sustainability. So I guess there's two things here is why is sustainability so important to you personally? And then kind of perhaps some sort of key insight that you might give to someone who is listening to this, might be a potential investor or just somebody who may be just interested in this area.
Sure. So first of all, why is sustainability important to me? And my strong belief is that all of us who are saving or investment do so for some related purpose in the real life, whether it's our own retirement or securing a good quality future for our children. And I think it's quite clear that in order to achieve these goals, we need to care for the planet and the society that we live in. I think finance can be sometimes myopic in that there was this belief that if you accumulate enough wealth or return, you can be somehow insulated from climate events or social unrest. And it's becoming increasingly clear that that's not really true. I think with global pandemics, with extreme weather events, it's very risky to assume that there is a feasible escape route. So I'm hoping that it's becoming quite clear that in order to build long-term value for the purposes that we're saving and investing from, we do need to start taking into account the impact on the planet, on society, on breathable air, clean water, and all that. So I think that sustainable investment is not just a moral thing to do, but a smart way to invest for the future. And what takeaway would I have for a potential investor is exactly this, sort of maybe reflect on why you are investing and what are you trying to achieve with your portfolio, which I'm sure that any financial advisor will do in the stock taking of the client objectives. And as part of achieving those objectives, I think investments such as the social impact trusts are quite aligned in terms of value. And of course, I would always say, talk to your financial advisor, and we're always happy to answer questions as well, either directly or via people like yourself, George.
Thank you so much. And honestly, great to speak with you today. It was great when we spoke previously. And, just sharing your insights and, certainly with the people listening to this podcast, it's given me a lot more confidence in the investment trust sector. But I think it's also given me confidence in those who are adopting the labels and what it means and that kind of transparency. So anyone listening, you can obviously find out more information at bettersocietycapital.com. And certainly to our listeners, I just want to say thank you for listening. If you've enjoyed this episode, subscribe for more insights from industry experts. We've got some great podcasts coming up and we'll be back soon. So thank you very much for your time. Thank you.